This is the Kendall Report for Thursday, March 5th, 2020. Welcome, everyone. I want to make sure that you hit the subscribe button and hit the bell so you know when I post these videos. The theme for today is going to be back to fundamentals. We started to see the talking heads around the markets, all the financial media actually start talking about fundamentals, which was positive. Meanwhile, the machines continue to run the markets. In fact, the last 2 days, volume was down 16%. On Tuesday, it was down 30% yesterday. So we're seeing volume extremely high, but it is still, the volatility is being driven by all of the machines that are in the markets. And this is not likely to change anytime soon. I expect to see a continuation of this volatility for several more weeks. This is an insane amount of volatility when you're seeing the S&P 500 move up and down anywhere from 80 to 125 points like we've seen over the past several sessions. So this is really difficult to deal with, really unnerves a lot of people. No one has a lot of confidence in what's going on, at least in my opinion. The same patterns that I continue to see for the last 5 or 6 sessions now. There's a lot of illiquidity, a lot of erratic trading, especially in the futures, and you got a lot of arbitrage going on between the futures and SPY and other ETFs. So there's a lot of activity that's going on from that standpoint. I believe the market frenzy is about to end. The craziness that we've seen, let's say in the last 2 sessions, we saw 2 big up days and 1 down day in the middle. I think this thing is going to stop. It has a lot to do with the technical pattern that I've been talking to you about the last several days. I'll go through that in a few minutes. So we're going to have jobless claims out early in the morning. We'll see how they come out. A lot of folks are looking for some kind of indication that there's any kind of softness in the economy. I don't think we're going to see that, but the ADP report did get adjusted pretty good, and we'll talk about that here in just a couple of minutes. The markets will start to attempt to try to get back to some normalcy, thinking about the few earnings reports that are still out there, and then also the unemployment and other fundamental numbers. Yesterday, we saw the release of ISM manufacturing came in better than expected, 57.3 versus 55.5. ADP report came in at 183, but there is a but. January's reading was down 209,000 from 291. So that's a big revision right there, and that affected market sentiment for a little bit when that came out, but not for very long because the machines kicked in and just drove this thing crazy. Mortgage index spiked, as you would expect, with rates down where they are. Refinance index spiked also by 26%. Who doesn't want to refinance right now? The beige book in the Federal Reserve was nothing. We already know everything they had to say. Consumer spending, though, increased, and it continues to be very robust. And even though there's a note here that about tourism, reduced activity to the coronavirus, everything else continues to move. In the technical section today, we'll cover the S&P 500, treasuries, and gold. Yesterday's activity in the S&P traded all the way up to the 10-period moving average, which is currently at 3133. The high yesterday was 3130.97, so basically a perfect hit. We are seeing weakness overnight with the futures down we're down almost 0.75%. And this line that I've been talking about the last couple of days, I drew in some lines. Let's go ahead and draw in just a couple more lines just to kind of emphasize what's likely to happen here. So I've been talking about this pattern, and we were going to come up to these moving averages. Well, the drop in the 10-period moving average is so steep, it's still about 35 handles a day, so it's going to continue at this slope. It'll probably start to round off just a little bit, and these averages are going to be up here. So I talked about this, where my expectation is that we'll see some kind of right shoulder setup. We'll see a retracement from this high down toward maybe Monday's low, maybe a little bit below it. It's going to retrace here. And then the overall pattern that I'm expecting is that we're going to just see kind of a zigzag pattern. And I still expect this thing to finish on the downside. And ultimately what will happen is these averages will come into play. And this scenario here is going to actually be the focus of the technical picture for the next several weeks. This is not going to change. Now the PPMs down below, you'll see here has, they're upticking. I'll just draw arrows on each one so you can see them. They're all upticking. We actually saw a penetration of the first derivative on PPM2, which is somewhat of a positive, but this will happen in this kind of configuration. The PPM1 is going to be the focus, this first arrow here. This is going to be where it's going to drive the markets at least for the next 2 to 3 sessions, and this should set up this move to carry us back somewhere around that 29.95, maybe 29.65 would be really the target. But this pattern will continue to unfold over the next several sessions. The key numbers for today are going to be, on the downside, 30.98, which is likely to be penetrated early in the morning, and then 30.63, and if that's taken out, we could trade all the way down to 30.27 to 29 handle, all the way down to 3,000. The volatility says this is likely to happen. On the upside, 31.61 is the first resistance number. That's probably not going to come into play at all. It's possible if we get above 31.30, we could see this thing move up. I think the thing that I want to point out is that we're probably going to end up heading back toward the 200-day moving average. I mentioned last night that this is going to be like a magnet for the market. It's just going to, one day above the next day, it's just going to be oscillating around that 200-day moving average, especially with this 10-day moving average still at 0.81. That, depending on how this thing closes tomorrow, and in fact, if it closes, stays above the 200-day moving average, then this downward momentum on PPM1 is going to bleed off a little further, but it's still going to have enough downward pressure to keep the markets from getting above it. And if we did spike above it, it's not likely to close above it today or tomorrow based on just the probabilities. Right now, there's only about a 30% probability to close above the 33 number, and that's going to be closer to 31 tomorrow. So because of this decline that we're seeing in the average, that would complete a 5-day pattern. Then I expect there could be two things will happen. We'll most likely get 5 days of downward pressure, or it could be as much as 8, and this thing could just reverse and make a new low. And I continue to suggest for those of you, don't take this lightly. Don't get suckered into thinking everything's going to be okay now, because I still think you should lighten the load on any whatever's comfortable from the standpoint of how much cash you can have. I would continue to sell into these rallies and lighten the load. And if it does get up to 31.60 or so, it's just an opportunity. You're not going to be left behind on this market. And this number right here, you'll see some dots right across the screen here. I'll put a cursor on it. That number is 31.94, and that's the key pivot number. That's the pivot number between bullish and bearish. So if you got above that, we close back above 3,200, then that would give us more upside. That's probably not going to happen, but it's certainly something to watch with this crazy volatility that we've seen. I have not seen a lot of new buys coming in on the dailies just yet. So that's also confirming to me that we're likely to stay under some pressure here. On the treasuries, we did see an inside day. I talked about yesterday, we had this huge range after the Fed's action. And now what we're seeing here is that the markets are really starting to stabilize a little bit. It actually was back above 1%. We're at 0.99 right now, so we're right at the 1% number. Still think we're going to see this thing move back to about 110, 115 over the next several days. All of the numbers that we see, the PPMs, all these numbers are at extremes and are likely to start to soften up. Downward slope, just like on the equities, the downward slope in the moving averages are going to put a cap on how high rates can bounce from this level. Looking at the gold market, I talked about gold setting up a range. It was under a little bit of pressure yesterday. We're going to stay between 1670 And now we're probably apt to go down around somewhere around the 1625 to 1612 level. You can see all the momentum is changing quickly. It's already starting to fade on ppm1 and ppm2. So we're most likely going to see gold just back off here. We could down to that 1609 level right now, but it's actually a better target is 1612 on the downside. That's probably going to be the extreme. I don't think we're going to be able to get through the upper end of this range right now. I think if we did make a slightly new high, like I said, 1670 to 1612 is going to be what to expect here. Thanks for watching again. We'll talk to you again tomorrow night. Don't forget to subscribe and hit that bell.